Since the FOMC began tightening monetary policy, interest rates have risen across the yield curve, increasing borrowing costs for firms and households. Banks have seen the value of their securities portfolios decline by nearly $600 billion, reducing their capital and liquidity ratios. Recent interest rate changes and banks' associated unrealized losses have affected bank decision-making. We find that unrealized losses have reduced bank liquidity and capital, potentially dampening loan growth through 4 channels, including increased equity costs, increased debt funding costs, and reduced merger and acquisition activity. Unrealized losses can affect all types of banks, irrespective of size, regulatory treatment, or funding access. Public banks are more susceptible to unrealized losses than smaller community and non-public banks. Section I provides background on standard securities accounting, and Section IA examines recent trends in securities valuations. Accounting for changes in the market value of banks' securities portfolio, unrealized losses on trading securities can influence bank behaviors due to the way banks report securities on their financial statements. Trading securities are routinely purchased and sold and are reported at market value on the balance sheet. Investment securities are designated as either held to maturity, HTM, or available for sale, AFS, on the balance sheet. HTM securities are reported at amortized cost, while AFS securities are reported at market value. Changes in the market value of AFS securities can affect regulatory capital, a specialized equity measure defined by regulatory accounting rules. Non-advanced approach institutions can opt out of this reporting requirement, so regulatory capital is typically unaffected. Unrealized gains and losses on HTM securities do not affect assets, book equity, or regulatory capital. However, unrealized gains and losses on AFS securities affect total assets, book equity, and regulatory capital at large advanced approach banks. Banks may choose to sell AFS securities at any time to generate liquidity for other investment purposes or to realize gains that boost income. This helps banks avoid solvency issues during downturns and increases the probability that the bank will continue to lend. Market value accounting can make bank capital more volatile by requiring banks to hold larger equity buffers when interest rates change. Banks can avoid equity volatility by reclassifying securities from AFS to HTM, but reclassification is generally restricted, and intentional and recurring sales of HTM securities are prohibited. Unrealized losses affect bank balance sheets only because of accounting rules, and the argument against reporting unrealized losses on balance sheets is straightforward. If banks hold securities to maturity, the unrealized gain or loss will never be realized. ARIA. Recent trends in banks' securities portfolios during the COVID-19 pandemic. Banks' balance sheets changed dramatically, making them more vulnerable to rising interest rates. Banks have accumulated $2 trillion in new securities since the start of the pandemic, but these securities are not free of interest rate risk, making bank balance sheets more sensitive to interest rate changes. Banks purchased longer maturity securities to compensate investors for inflation, rising rates, or prepayment risk. However, longer maturity securities are also more sensitive to interest rate changes. Banks of all sizes increased the average maturity of their securities portfolios during the pandemic, but the value of these securities has decreased since the pandemic, raising the likelihood that banks would incur losses should they need to sell them. Securities valuations fell precipitously as interest rates rose during 2022, and unrealized losses on all securities were about 30% of aggregate Tier 1 bank capital. Unrealized losses on HTM securities were larger than those on AFS securities, suggesting banks were strategically protecting their capital levels. Banks that cannot opt out of reporting AOCI in regulatory capital, such as large banks, have classified more securities as HTM. Publicly traded banks that are not subject to reporting AOCI in regulatory capital, such as smaller banks, have also classified more securities as HTM. Since the pandemic, banks have increased the size of their securities portfolios, but have also become more exposed to interest rate risk. III. Potential effects of unrealized losses on bank behavior. Unrealized losses have increased substantially since the pandemic due to higher interest rates and duration risk. This may influence bank lending decisions. Effect of unrealized losses on equity prices. Unrealized losses can reduce the total market value of a bank. thereby lowering equity prices. In 2022, bank equity prices declined about 30% while interest rates rose and unrealized losses climbed. One reason for the decline in bank equities could be lower asset valuations resulting from unrealized losses. Lower valuations make banks riskier, all other things equal, and should raise the cost of equity. Effective unrealized losses on debt cause lower securities prices, increase insolvency risk for bank debt holders, and make banks more reluctant to sell securities at a loss, increasing demand for debt funding at banks. In 2022, interest rate spreads on bank debt have increased relative to the cost of funding at similarly rated non-financial firms. The increase in interest rates has been associated with a widening gap between lower-rated banks and their higher-rated peers. Effective unrealized losses on loan growth lower securities prices may have indirect consequences on lending through lower equity and bond prices, which may force banks to slow loan growth rather than increase expenses and capital buffers. In 2022, average loan growth was robust, implying unrealized losses did not constrain overall lending. However, banks with fewer unrealized losses expanded loan growth more than their peers with more unrealized losses. Effective unrealized losses on mergers and acquisitions unrealized losses could reduce M and activity through two channels. First, they reduce firm value, and second, potential buyers may be wary of institutions with large unrealized losses because they increase bank liquidity and default risk. Recent commentary from bankers suggests that unrealized losses have indeed depressed M and activity, and the trend seems to be worsening. Unrealized losses can reduce the value of banks' assets, erode their capital levels, and increase their riskiness, which can lead to lower profitability and less ability to market themselves to potential buyers. Conclusion: rising interest rates have reduced asset prices substantially in the last year, and this may negatively influence capital and other financial ratios, and may also influence bank behavior in four ways: increasing debt usage, raising funding costs, tightening lending standards, and avoiding acquisitions. Our analysis suggests that unrealized losses may increase as interest rates rise, reducing economic growth and potentially motivating monetary policymakers to adjust their policy stance. Bank regulators may need to reassess how interest rate risk is publicly disclosed.